So I've had a request, I think it was from Dylan S, to go through this cash flow statement question, HQV PLC. It was actually on a specimen paper. So before the new specification came into being, they released some specimen materials to give us an idea of what we might expect. And this HQV question is an excellent example of a cash flow because we've got to kind of start from scratch. We're given a statement of financial position, we're given a load of additional information, and then just told to prepare a statement of cash flow. So with the Claudia one that I did, I think probably last week, that was one where it was some of it was pre-populated and you had the layout. With this one, you have to go from scratch. So we need to remember what goes where. So it's got pretty much every calculation that you could wish for in a cash flow statement. So what I'm going to do now is just work through it because I don't think that the mark scheme that's been provided is particularly helpful. The way they've gone about finding missing figures for non-current assets, for example, is a bit peculiar. So I'm just going to take you through this now. So we've got a statement of financial position. I'm not going to discuss that in detail. It's been prepared under the sort of alternative layout. So we've got assets at the top here, and then we've got equity and liabilities at the bottom. And obviously the idea with the cash flow is to start with your profit from operations and to work through primarily the statement of financial position, seeing what's happened from year to year. So where we've used cash. So I'm not going to go through the basics because I think I've done that in another video. So we've got those figures. Now, the one thing to be really careful about is the years. So make sure you know which way around you're going. So in this case, 2015 is on the right, and that is the more normal way of laying out accounts. And we're going to 2016. So just make sure you clock that because every now and again they might give you some numbers around the other way. So not so much with cash flows because it's usually on a published statement of financial position that we're basing it, whereas with ratios it could be any way around. So just a little reminder about that. Right, so we've got some information here, and it's always important that we have a little look through just to see what we're told and probably try and identify things that we're not told. So we've got some additions of non-current assets. And if you remember, the statement of cash flows is broken down into three sections. We've got the net cash from operating activities, which is the money that's been either generated or used in the day-to-day trading activities. Then we've got our investing activities. So that is money that's either been used in or generated from usually the investment in non-current assets. So we'd have an outflow if we've bought any non-current assets like we have here, and an inflow if we've sold any like we have in note 2. The next section is financing activities. So that's how we've paid for things, large items. So if we borrowed any money, if we issued debentures, if we redeemed or repaid debentures, loans, that kind of thing. If we borrowed money, that's an inflow on the cash flow. If you remember the double entry, debit the bank, credit the non-current liability. If we have issued shares, that's a source of finance, remember. So we need to look at, if we go back to the statement of financial position, has anything changed down in the equity section? So yes, we've got an increase in the share capital. We've also got an increase in the share premium. So we can see that during the year, they've issued some shares at a premium. Another thing to be aware of here, there's no little dash there, but we've got a revaluation reserve that's crept in. And you might be thinking to yourself, well, how is that going to affect the cash flow? Because the revaluation reserve is just down in the equity, no cash has changed hands. But if you remember the double entry for that, we will have debited the non-current assets at cost and credited this revaluation reserve. So often we're going to be trying to find a missing figure. It might be additions to non-current assets. It could be the cost of a disposal. We might be trying to find a missing depreciation figure. So it's really important that we clock any increase in the revaluation reserve because that will be one of the figures that we do know about that we can kind of sub into the calculations when we're working out a missing number. So let's have a look at the rest then. It does actually tell us their property was revalued. So that is a red flag. We need to do something with that information. Not always the case. Sometimes I've seen questions under the old ACCN 4 spec where they didn't tell you, they didn't highlight the fact the property had been revalued, whether that was deliberate or just an omission on the part of the examiner. I'm not sure. No other additions or disposals to non-current assets. We've got some information about the tax paid. So that's the actual outflow of money that's been paid out in tax. So the tax paid is going to go in our net cash from operating activities calculation. Dividend paid, so we've got 1,334,000. Remember, that's going to be an outflow under financing activities. And then we've got some information from the income statement. So depreciation charges were 1,217,000. So that's going to be useful, as I said before, when we're trying to calculate our missing figure. We've got finance charges. So that is your interest paid. That's going to be an outflow under the operating activities. And then the provision for taxation, that's the provision. So that's the figure that's been put on the income statement. That won't actually be paid until next year. Okay, but we will need to adjust for that in a minute. I'll show you why. Okay, so that's all the basic information. Now, here's one I prepared earlier in true Blue Peter fashion. Anyway, we've got the cash flow that I've laid out. So hopefully you are au fait with this. One of my colleagues developed a mnemonic to help us remember what goes on here, and it involves penguins and drunk dinosaurs in Rome posing cutely in the nude, which is quite amusing, I think. I might have to try and record a separate video on that, but the P for penguin stands for profit from operations. We've got two Ds, drunk dinosaurs, depreciation and disposals. They're in Rome, which is the inventories and the receivables. They're posing, which is the payables. Cutely, cash from operations. And then in the nude is the interest paid, the tax paid, and the net cash from operating activities. I've put in some possibilities here for the investing activities. So it's buying and selling non-current assets in there, not likely to see anything else. And then financing activities. We've got the issue of shares. In this case, it's an issue of debentures. So it's money coming in. We've borrowed money. And then an outflow for dividends paid. And then if you remember right at the bottom, I haven't got any more mnemonics for the rest of it, you'll be pleased to hear. We've got the net decrease, or in this case it's a decrease, but sometimes it might be an increase in cash and cash equivalents. That's going to be the result of subtotaling the net cash from operating activities, the net cash used in investing activities, and the net cash from financing activities. So those three totaled up will give you the overall increase or decrease in cash and cash equivalents. And then we can put in, from the statement of financial position, we're going to be able to put in cash and cash equivalents at the start of the year, which was an asset. So at the end of last year, we had 87,000 in the bank. But by the end of the year, it had gone down to an overdraft. So don't ever assume that the bank is zero. Okay, they probably should have a dash in there, but no company ever has managed to get exactly zero in their bank account at the end of the year. Usually means that one is a current asset, one is a current liability. So money in the bank at the start of the year, overdrawn at the end. So we will be expecting to see an overall decrease in cash and cash equivalents. We can now make a start on the statement of cash flows. And the first figure we need to find is the profit from operations. Now, if you have a look carefully at the additional information, they haven't told us what the profit from operations is. So we are going to have to find it working backwards from the increase or decrease in retained earnings. So retained earnings have gone from 3712 last year to 4332. Now that's going to be made up of the profit for the year after tax minus the dividends. So profit for the year after tax, if we want to work backwards up to there, we need to add back on the tax estimate of the tax liability that's gone into the income statement, and also any finance costs that have been included, they need to be added back to get back to profit from operations. So this is a pretty standard calculation. I've already made a start on it here. So the increase in retained earnings, as I said, we've gone from 3712 to 4332. So that's going to be the starting point for this. And then we've got to add back these things, because if we think about how the income statement works, we've got profit from operations. We take off the finance cost, gives us profit before tax. We take off a tax provision, what we estimate our liability to be, and that will give us the profit for the year after tax. That then goes off onto the statement of changes in equity. So it gets added to the retained earnings brought forward, and then we take off dividends paid to give us the retained earnings carried forward. So the increase in retained earnings is kind of dealing with the opening and closing balance. So we've just got to add back dividends paid, the tax provision, and the finance costs. And most of that is given to us in note 6. So the dividends paid totaled 1,334,000. We don't need to work that out. So let's add that back on, because we're trying to get back, if you remember, from the increase in retained earnings back up to profit from operations. The tax provision in the income statement is this figure here, 512,000. So let's add that back on as well. And then the finance cost, the interest that we paid, 402,000 goes in there. So if we add those four figures together, we get the profit from operations, which is 2,008,000. 868,000. And at last, after all that, we can pop that figure into our statement of cash flows. So 2,868,000 there. So that's the first step. Then we can start working through here. Now, some of this is going to be really easy to pick up straight from the information. So depreciation charges were 1217. So we're going to add that back on. Now, what we're doing here is we're saying, well, this was the profit from operations. What we're trying to find is how much cash was generated from those operating activities. So we need to add back anything. So this is a non-cash adjustment. So the depreciation would have reduced the profit for the year, but it doesn't have an impact on cash. It's just a book entry. So remember, it's when we buy and sell the assets, which is down in the investing activities, that will have an impact on cash. So we're adding the depreciation back. Okay, we'll do the same with a loss on disposal. If it's a profit on disposal, be careful with that. You need to deduct it because it will have increased the profit from operations, but it won't have increased cash. It's the disposal proceeds in investing activities that will increase cash. Okay, now disposal of non-current assets. This is another slightly tricky one. We've been told that equipment was sold. So in note 2, equipment was sold for 830,000 and it had been depreciated by 485,000. Now, what we don't know at this point is the cost. Okay, but what we do know is that they bought some extra plant and equipment, so £6,600,000 worth there. There were no other disposals or purchases of non-current assets. And if you remember, property was revalued. Now, this is quite a common task in a cash flow question. So we've got to try and work out the missing figures from our non-current assets. Now, sometimes they just give you the net book value to work on, so you can just do one column, but the process is exactly the same. Now, my process is not the same way they've presented it in the answers, so hopefully you'll find my process a little bit more straightforward. What I'm going to be doing is starting with the brought forward figures. We know that they're correct, so we need to start with those, add and subtract anything that we're told about, and then compare that with the carried forward figures, so the ones in 2016, to find the differences. So I've set up 2 columns here, and the first thing I'm going to do is just pick up the opening balances. So for cost, it's 14,884. Remember, we're abbreviating this to the nearest thousand. So 14,884 is going in there. And for the accumulated depreciation, it's that figure there. So those are the brought forwards. I've got 4,113 in there. Okay, now additions to non-current assets we were told about. We were told that additional plant was purchased 6.6 million. So we can stick that in the cost column. That will increase. So we're going to add that on. Okay. Disposals. Now we know about disposals. We were told that equipment was sold for 830. Well, that's the proceeds. We don't want to put that in this calculation. We're going to use that in our investing activities as an inflow. But we're told that the asset that was disposed of was 485, or it had £485,000 worth of depreciation against it. So we can take that off, because remember, when we dispose of something, we need to remove the cost and we need to remove the accumulated depreciation. So if you want a recap of that, go back to my schedule of non-current assets video. Now, we don't know what this figure is at the moment. We don't know what those assets cost, but let's put everything else in, and then hopefully that will come out in the wash, as they say. So let's have a look at the revaluation. What was the situation with the revaluation? Well, we went from a revaluation reserve of 0 to one of 1,830,000. So that has increased the value of our assets by 1,830. Nothing to do with the depreciation column there. And then we also know they told us very kindly that the depreciation, we didn't have to work that out, depreciation charges of 1,217 had been included in the income statement. So we need to add that to the accumulated depreciation. So all I've done is just put in the stuff that we know about. Now, this depreciation column, if we do the 4,113 minus 485 plus 1,217, you get a total of 4,845. Okay, now if we just have a little look and see what's on the statement of financial position, 4,845, that actually agrees. Okay, so that's the correct figure. We put a little smiley face there. So we don't need to do anything. There's nothing missing in the depreciation column. But if we look at this figure here, 21,450, if we pop that in at the bottom, okay, and if we add up all of this lot, so if we add up 14,884 plus 6,600 plus 1830. Let me just do that with my calculator now. So 14,884,6600 plus 1830. That actually adds up to 20, I don't know if you can see that there, 23,314. But we only want it to be, so 23,314. We only want it to be 21,450. So the missing figure has to be the cost of those disposals. So the difference there, 21,450, is actually going to be 1864. So we can now get rid of that question mark, and we know that that is 1864. Okay, so we're almost there with this one little figure we're trying to find, a profit or loss on disposal. So to find a profit or loss on disposal, remember you need the net book value, so the cost of the asset minus the depreciation to date, and compare that with the sale proceeds. So the cost from working to, we just worked out, is 1864. The depreciation is 485. So 1864 minus 485, I reckon, is a net book value of 1379. And we know that the proceeds, because we've told that somewhere here, the proceeds, back to lots of jiggling around with paper here, the proceeds of the equipment sale, 830,000. So we can put that in, and then that means we've made a loss on disposal of 549,000. So the 1379 minus the 830. So after all that, all we were looking for there was that one little figure, that loss on disposal, and there it is. 1 million, sorry, not 1 million. That's the figure we're looking for. 549,000. Okay, and again, sorry, I haven't moved the paper in the right place. We're adding that back on because it's reduced profit, but it hasn't reduced cash. So we're adding it back on, kind of like it never happened. Right, then we can go through, this is the nice straightforward bit. So remember, anything that uses up cash is going to be a negative if it's bad for cash. So if we'd increased our inventories, that would be an outflow. In fact, they've actually decreased their inventories. Their inventories have gone down from 805 to 779. So that looks like a decrease of 26,000. So that's good for cash. We're not having to pay for that inventory. Trade receivables, though, have gone up. They started at 214 and they've gone up to 311. So they've actually increased by 97,000. And we're going to take that away because we haven't collected that money. So if we've increased trade receivables, that's cash that hasn't come in to the business. Okay, so that needs to be taken as an outflow. And then the trade payables, we've actually decreased those. So that's great for our relationship with our suppliers. So they've gone from 652 to 345, which is a decrease of 307. But we're going to take that away because we've used that money, we've paid that to our suppliers, therefore we've reduced the amount of cash that we've got available. So the next thing is the cash from operations. It's 4,256,000, and that is just a subtotal of all that lot. So that's going in there, 4,256,000. Then we've got to take off the interest paid. That was one that was given to us in note 6. If you remember, the finance charges, 402, obviously an outflow. The bank is not going to pay us. And then the tax paid. Now, this is another one that sometimes we have to work out, but in this case, I think they've realised they've given us enough work to do. So they've given us the tax paid figure there, 398,000. I think the Claudia cash flow question goes through how to work out a missing figure on the tax. So 4256 minus these two is going to give us net cash from operating activities of 3,456,000. So that goes out into the right hand column because remember we're trying to find three subtotals here. Purchase of non-current assets, that was given to us as a note. So we're going to start with the investing activities. So remember, buying and selling non-current assets, kind of on the home straight now, you'll be pleased to hear. The additional plant cost 6,600,000. So let's pop that in as an outflow. We sold the equipment for 830. That's an inflow. So one minus the other means that we've used cash in our investing activities of 5,770. Then we can move on to the financing activities. Now, we need to find what's happened with the shares. Now, if we add these two together, let's get my trusty calculator again. So 6,300 plus 2,170 is 8,470. That's the total of the share capital plus the share premium. And if we compare it with the total of those two, 4,200 plus 1120 5320. We can see there that there's been an increase of 3150. That's an inflow, that's money that we've received from a share issue. So that can go straight in under financing activities, 3,150,000. Debentures have gone up. So the difference between those two is increased from 1750 to 2100. So we've got an inflow there. We've borrowed more money, 350,000. And then the last little figure here, dividends paid, if you remember, was on here because we've already used that figure, 1334. Okay, so overall we have generated cash. We've got net cash from financing activities. It's a positive of 2166. Okay, so after all that, it's been quite a grueling task, hasn't it? We're going to add those three, add and subtract as necessary, and we can see that overall our cash has gone down by 148,000, and we're going to prove that by starting with the bank balance at the beginning of the year. Cash and cash equivalents at the start of the year, 87,000. So let's pop that in. Cash and cash equivalents at the start, it was a positive. Now, if we do minus 148 plus 87, we get a negative of 61. So let's check that. That should be an overdraft of 61,000. And let's have a look under current liabilities. And there it is, 61,000. So hopefully you're all still awake and I haven't baffled you too much. If you've enjoyed the video, please subscribe to my channel. Watch out for future videos. And thanks very much for watching. And again, good luck for Monday.